Good morning, everyone, and thank you again for joining us today on Tax Tuesdays, which is live on LinkedIn. My name is Rayhan Aleem. I'm joined by Rashmi, one of the most knowledgeable individuals on corporation tax in the UAE. Thank you for joining us on our Tax Tuesdays webinars. So in these webinars, we go through deep dives on corporation tax issues. Now, one of the things that I find anyway, is a lot of business owners, a lot of entrepreneurs, they're relying on accountants to know the rules and help them understand and apply it. However, the rules are coming thick and fast all the time. So how anyone can stay on top of the rules is not an easy job, even for accountants. So we've created this deep dive, so we're able to kind of go through some of the very technical aspects of the corporation law. We also have a Q&A at the end, and we just want to make sure that any questions that you have, we can answer, and we can go through some of these topics that are very, very important. So today we'll be going through the realization basis, and this is based on the ministerial decision number 134. Now, one of the things that you have to take into consideration is that a lot of these this is a part of an election, and a lot of these elections is a one-time thing that you can do in your first tax return. And when you look at your FTA tax return, there's a number of boxes that you have to fill in. Once you filled it in and you submitted, that's it. There's no turning back. Very, very difficult for you to then go back and amend it. So you want to make sure you get it right. You want to make sure you join us for the Tax Tuesdays webinars, where we go through these deep dives of these very complicated technical topics, so you're able to then have the confidence to be able to prepare a correct tax return for yourself, for your client, for your boss. So Rashmi, do you want to just give us a quick introduction about yourself?
Okay, sure. Thanks, Rehan. Hello, everyone. I am Rashmi. I head the tax department with JRB. I am one of the rare people who like taxes, and I like reading taxes and talking taxes. And I am being honest, I really enjoy it. So I've done taxation 7-8 years in India. But what's happening in UAE, as we're trying to highlight, what is interesting is it's a transition time. We are transitioning from the non-tax to tax. It will become simpler. The tax returns will become simpler going down the line. But this 1-2 years being the first few years of compliance, it is important that what are the choices you're making. And as Rehan rightly highlighted, certain selections that you're making, they are going to be a lifetime elections, non-recoverable, irrevocable elections. So it's super important that we understand how they are going to impact us, not just what you're looking at your balance sheet and P&L today, how your business is projecting, and tomorrow what do you see as your P&L balance sheet having as assets and liabilities, and then how will it impact you. So it's super important that we understand the depths of it. And that's the attempt we are making here to make the deep dives. We all know the names of the provisions, or we can guesswork what's what, but how it's going to impact each type of business, what are the crucial points to look into it before you make these return elections, is what we're trying to do here. So yes, Rehan, I like taxes, and I like Rehan because Rehan likes taxes. So that's that. So we like, JRB likes Taxstar.
Yeah, I like tax as well, but in the UK there's an advert with HMRC. I think it's HMRC, and
Yes.
they always say tax doesn't have to be taxing, right? So we're trying to make tax not too taxing, because we're trying to break down the technical aspects that a lot of people gloss over. A lot of people just look at the 9%. A lot of people look at the deductibles. They look at what losses they can do. A lot of people looking at free zones, but there are very specific aspects of the law that maybe many people are glossing over. But you're bringing them back and saying, look, you actually need to think about these concepts, because it's very, very important that you get it right, and you've only got one chance to get it right. So 100% agree. And yeah.
So yeah, shall we start, or?
Yep.
Okay. So the topic today. So it is kind of in continuation or in connection somewhere at the end of this session. Maybe we'll connect it to our last session, which was the transition provision, wherein we said that we have to make that election. Uh, the the topic in specific today is the realization basis. Just to give you an overview, what does it mean? Basically, is that we know in our assets and liabilities, it will be a mix of accounting and tax discussion today, because we need to know how we are recording them and how we're recording them in our P&L balance sheet as of today, and what tax impact will it have from there. So, therefore, again, bringing back the importance of your correct accounting, your IFRS understanding, your books being compliant with IFRS, because that again becomes your starting point. Once you have that, you know that we can record your assets, liabilities on realization basis or your fair value method. You might be following accrual and cash. Certain specific companies below certain limits of turnover, and in special cases where there are government organizations, etc., can do cash basis accounting. We're not talking about them. We're talking about the majority, which would be doing the accrual basis of accounting. Now, when you're following accrual basis of accounting, you follow different methodologies for your assets and liabilities. Most of the current assets and liabilities, we would be carrying IFRS 9 implications at fair value. You might have assets at revalued method. You might have been carrying them at cost method. You might be doing fair value method if you are investment property holder. So you would know in your financial statements, first starting point is that you decide on 23 year end that all your policies are what your company wants. You're carrying the assets at the fair value or cost model or revaluation model, whichever you think is right, fair value through OCI or through PNL. Now, once you have identified that, what does realization basis option mean? Is we can go to the next slide. What does realization basis option mean is that in the first return, you would be able to make an election. When you make an election, that means you say that I want to pay taxes on my assets and liabilities when I actually realize my gains or losses. So if I have an asset and I make a provision on that, say if I have a I have a shareholding in a company on a listed market, and at the year end, if I make the fair value adjustment, I have not earned that loss or gain. I've just made an adjustment for the fair value. I do not want to this year pay tax on it. I hold a lot of shares and they keep going up and down, and I have these unrealized losses and gains that I book in my books, but I don't want to pay taxes on it when these are fluctuating. I want to pay it finally when I actually sell and realize and actually know what's my final profit or loss. This is that election that we're talking about. If you say I elect to pay tax on realized value, then it will be finally when you realize the gain or loss that you will make that tax payment. If not, there is, if you do not make this election. So now what is also important is we understand what does it mean when you say I make this election. So if you do not make this election, you have an option. You do not make this election means what? Means that all your fair value adjustments in your books will also become the basis of paying taxation in the taxable income calculation. So if I did a provision for fair value, if I booked a notional gain, fair value gain, I will pay tax on it. If I book the loss, that will be a deduction as such without any adjustment in my P&L.
So just sorry, Rashmi, just to
Yeah,
kind of, because
go
we're
to the
going
next.
into account, yeah, because we're going into account, and this links into tax, right? So just want to kind of put out some practical examples, just so our audience can understand. So those who've joined us just recently, we're doing a deep dive into the realization basis, and this affects a lot of the accounting policies that you have in your books, right? So just bear with us. So for example, like we have clients, right? And we have we use Zero for a lot of our clients, and we have some aspects of Zero where it automatically revalues some of the assets if it's recognized in foreign currency, for example, right? And then there's other assets that you have to manually kind of revalue, right? So for example, your shares, because you don't link it to it's not linked to like a Bloomberg terminal or whatever, right? So practically speaking, what happens is at the end of the year, you're going to revalue a lot of your assets and liabilities, right? Some companies may do this, some companies may not, depending on their accounting policy. So you have to kind of keep in mind that this is an additional process that you'll have to do at the end of the year if you're not already doing it. And so that's your financial statements. Now you got your tax, right? Now you may have assets that you revalue at the end of each year, but you may elect not to recognize them in your tax return, because you may say, okay, my value of shares in Apple has gone up by 10%, but it's not realized because I haven't sold it, right? It's just on my books. But on my tax calculation, I may decide to elect not to realize the gains or losses for my shares in Apples, or I may decide to realize it as and when that happens at the end of the period. So I think we have to think about two processes that sometimes are in line and sometimes are not in line. And these are things that you have to kind of think about at the very beginning, because if you're going to, whichever way you elect to go, whether it's realized or unrealized, it's going to affect two processes. Process number one is going to be your books. Process number two is going to be when you do your calculation, your tax calculation for those realizations. And I think that is super important that we all understand the implications, because, for example, if you're going to an independent third party to do a revaluation of a building, for example, right? And you haven't filed your tax return yet, and you come to August, right? And your deadline's in September, and they say to you, "Oh, we can't give you a valuation report until the next 3 months," right? Then you're going to miss your deadline, and it means that you're not going to be able to get a valuation, the correct valuation for your building, right? So I think there's a lot of things that this rule creates a lot of processes underneath, which you have to really think about, which Rashmi, you're obviously bringing up. So I just want to re-emphasize that point, because I think, realization is not it's not one of those things where sometimes it's an easy thing to do, where you can get the market value of something on live markets, and sometimes you can't get live valuations. You have to get an independent third party to do that. So I've been babbling on. So
no, makes sense. No, makes sense. Some very important points, and I think you've highlighted and touched on a few things which going forward we cover, but then they're super important to look into, and therefore I think taking this into consideration, why I said and why we say that it's not about what your P&L and balance sheet is today, what it will be down the line. That today's realization basis or non-realization basis election makes a difference, right? So one is a discipline of closing your books of accounts in time and closing of your books of accounts in accordance with IFRS. Now, IFRS always wanted and had this IFRS 9 adjustment, and you had to do your ECL on your receivables, and you had to choose to record your share investments at a fair value or a cost model, right? But how many of us were actually following IFRS to the extent that we were doing it while closing our books, unless we were getting them audited? So again, going back, audits sometimes bring this discipline that you decide these policies, decide these disclosures, have somebody vetting it for you, that whether this is correctly done or not. However, a few other things that you said we will cover as we go through the next slides, and I will take a point of what you said about the revaluation of asset, or say fixed asset, taking market value. How do we keep up with those challenges, and what should companies think while making this election? If we move on, let's get there, and then so there is to cover that risk of yours, there is, in this election, there are two options. Okay, we'll call it election A and election B. The law does not define it as election A and B, but for easy discussion's sake, we are taking it as A and B. Now, if you elect the option A, that means that you're going to elect to apply realization basis election for all your assets and liabilities. That is your current as well as non-current. Okay. Now, differentiating from transition gave you further election options of asset wise, this wise, that wise, right? Keeping that aside, when you are on realization basis, again, where we get confused, I want to take it a little slow, but then surely to understand. Election means you're saying I'll pay tax on realization basis. My books may be on fair value. My books IFRS 9, my there might be a provision on my ECL provision on my receivables. There might be an adjustment on my share investments. But I am saying that I'll not pay tax on it. I will pay when I actually realize. What's the full scenario looking like? So, like a share, like an ECL, I made provisions. So, I have booked an expense in my books or have booked a gain in my books. But when I do my taxable income, I start with the profit before tax from my P&L. And then I said, okay, this gain I don't want to pay tax on. So, I will reduce this from my profit. This provision is not a deductible expense because I said I want to pay on realization basis. So when I finally settle this trade receivable, I want to pay that tax then. Right now, the ECL provision I will not consider. So I will add that back, right? Now, in your books, you need to decide what creates the most fluctuation, because this fluctuation will also result in your deferred tax assets and liability. Now, this is what is creating timing difference between your books and your tax payment, right? So now you're saying that in my books, this is an expense, so my profit is different. And in my taxable income, there is a timing difference that today I'm not paying tax on a realized or unrealized profit. So there is a track recording and another impact of accounting that will come in because of the time difference of what you're booking in your books versus what you're paying tax on.
Yeah,
Now, this is
that's what
election
deferred.
A.
Yeah,
Yeah,
this was
there's
deferred
where
tax.
the deferred tax asset and
And I
liability.
guess we should probably do another deep dive on deferred tax at some point.
Sure.
But this is definitely one aspect. There's multiple aspects of deferred tax in the current law, but this is definitely
Material
one
ones.
of the aspects, yeah,
Yep.
that is going to create some issues in terms of the way you record your deferred tax. So yeah, great point. Great point.
And then if you make an election B, now they have given this option, and I want to bring forth why this is important. They have given an election B, wherein again in transition provision we had asset wise election. Here it is class wise, all current assets liabilities, all non current assets liabilities. But they actually give you one option that you may elect that I want to do this realization basis option only on capital, so only on buildings or intangible assets or all that rest of my books. Because if you see a normal trade basis or a normal business which does not have investments in shares much or other investments or other financial assets which are not related to core business, then the election B makes sense that my normal books of accounts, my provisioning are actually my all my provisions and fair value assessments are indicative of my actual profit and loss during the year, and I want to pay tax on this. There is very unlikely fluctuation like shares that today it's high and I pay tax and tomorrow it's a loss and I don't pay tax. It's more on my inventory, my receivables, my this, that, the other, which is my actual performance of the year. And on those assets, I don't want to keep creating deferred tax asset liability. I don't want to go on realization basis because trade receivable, when will I file a write off on this? Only then can I claim the loss on my trade receivables. Huh? However, assets, capital assets play a different role. I might have an investment property which I keep at fair value, and my fair value gains might be very high or low, but I might not actually end up booking that asset, that profit or loss very soon. So I don't want to do it for capital assets. I don't want to do the revaluation. I don't want to do the valuations. I don't want to go through there. It's a cost model, and I want to pay tax when I actually realize. And my cash on my realization basis, I only want my capital assets. My books are okay for the other assets. Then you can make election B. What they've smartly done is financial institutions like bank, insurance, because of the type of current assets that they hold and the amount of adjustments of fair value they keep need to doing that, financial institutions can only have election B. They can only say that I want to pay it on realization basis for capital assets only. For their normal assets, they have to pay it on as per the books IFRS compliance basis. That's your fair value method. So normal businesses, how what is our suggestion? Unless, of course, this is a macro approach, you need to look at your P&L and balance sheet in specific. But if your business is a normal trade business, normal consulting business, your assets and liabilities are mostly pertaining to your business assets and liabilities, that is your receivables, your this, that, the other, you only hold a few long-term assets, you should go for election B, wherein your P&L, your taxation, your tax payment will be more indicative and near to your actual business performance. Your fair value gains and losses are actually reflecting your business assets and liabilities, and therefore, and you will not unnecessarily get into a lot of deferred tax assets and liabilities, timing difference, proving, etc. However, businesses which are more prone to making investments, having a lot of, and they know their investments, or they're planning to make investments in a lot of shares, holding, there the fluctuation can be very material. And you can suddenly have a profit which might not actually be realized in 2 years, and you still end up paying taxes this year. And when you book losses or actually have losses or down, then you, so it can really impact your cash flows and even impact how you are planning your taxation. So therefore I said you need to know what will be in your P&L balance sheet, what is the company planning to do in long term, what types of assets will you hold, how fluctuating they will be, to elect whether you want first realization basis, and if you want realization basis, do you want it to not overall your assets and liabilities or only on your capital assets and liabilities?
I
Yeah.
think also a key thing to take into consideration if you're a normal business is if you have an advisor or if you have an audit firm or if you have an accountant that tells you they should do election A, then you know that they're making money out of you because there's a lot of work that's required. If it's election B, then you know that they're a bit more honest in terms of you know how they're serving you. Because right now, obviously, I know that many consultants would try to take advantage of customers, right? And it's all about getting the right advice and practical advice as well, which we both advocate, right? So,
Yep.
yeah. So if your advisor, gives you that advise you to do that, then obviously you know that you probably want to question why that is.
If you are starting this conversation, let me add two things to it. So if you ever want to make this judgment and question your advisor or select or see what your advisor is doing, first thing is anyone giving you a shortcut in preparing any of your financial statements right now is a no-go, unless they suggest that either they do your IFRS compliance reporting or they get it through an auditor done. Any other shortcuts might be a lucrative thing right now, but you're saving bucks or you're saving pennies, which might result into a far more impact tomorrow. So no shortcuts, especially these 2 years in your reporting, in your accounting, in your financial preparation. Again, the responsibility is always of the management, the owners of the company. The consultants might change, the accountants might change. You will always remain reportable for the compliance. So any consultant telling you to oversimplify or corporate tax does not matter to you, it's only 9% on the profit, is not the right way of approaching it for me. Yeah. Yep. Okay. So election A and B, again, very quickly, A for all your assets and B is only for your capital assets. This election, again, can only be made in the first return filing, only once, irrevocable. And financial institutions do not have a choice between A and B. They only have a choice, either B or no election. So either they pay on realized basis only on capital assets or across. Yep. Next. Tim, you were saying something? Yeah.
No.
Okay. So, as we said, that in whenever the realization event will occur, so if you chose for realization basis, what will happen is till the point the realization event occurs. What are realization events? You actually sell the property, you actually book the loss, you actually write off your trade receivable, you actually let go of the inventory which you're not going to recover or whichever. So, whenever this realization event occurs, that particular year will have your impact of taxation of all across the years of holding of that asset. Okay. So if you had inventory across 3 years, and then you finally, its value kept decreasing, and then the third year you actually take the hit. In the third year, you will pay the losses, or you will claim the losses of 3 years together when you actually book the profit or the loss on that. Now, as we have said, because the measurement in the books needs the assets and liabilities to be on fair value. It has to be recognized in the fair value in most cases. So if you choose for the fair value, your books versus your taxation point of payment or realization of gain and losses will differ, and it will create your deferred tax assets and liabilities. I think that's it on this one. Timing, we have said. Measurement, we have said. Yeah. Non-financial assets and financial assets and liabilities. Okay. We all, I think, understand the current and the non-current. So there has been a definition given on what is capital, what will be your election B, that is your capital assets and liabilities, your intangibles, anything more than 1 year, going by IFRS. What is interesting is for all these elections, financial assets, current assets, non-current assets, all these elections, you go back to the definition of IFRS of these. The law is not redefining any of these assets and liabilities, any of these categories. So all these assets and liabilities definitions, current, non-current, capital for your election will be driven from your IFRS definitions of the current and the non-current. Okay. Now, these are only how the adjustments would be, because if you're booking it at original cost, or you're booking it as fair value, or you're booking it at realization value, the special treatments of financial instruments, we know IFRS 9 adjustments need to be done. If it's a non-financial asset, then you might have amortization, or you might have depreciation. If it is an investment property, you might have a fair value adjustment. One interesting point for, don't want to overcomplicate, but just have to keep it in mind. If you do any revaluation, right? Again, if you say on realization basis or revaluation, you have to see that the depreciation claim has to be restricted to the cost of the any gain or losses which is on revaluation that goes into your reserve has to be ignored. So I don't want to go into that many details, because I think revaluation might not be very relevant. Revaluation of fixed asset might not be relevant for a lot, but then that trigger should always come. If you have a revaluation in your books, then you need to see whether the depreciation charge is towards your revalued amount gain or towards the cost. It has to be, the claim of depreciation has to be restricted to the cost and not to the revaluation gain charge out.
Yeah, no, that's a good point.
Yeah. Okay. Moving on. I've covered this. These are the realization events. So
Okay.
when you sell or dispose the asset, when you settle the liability, when the asset becomes worthless, that you will actually write it off, or if the liability is forgiven, if the legal rights are lost, or if the legal rights are written off towards anything, that will create a realization event. Now, only exclusion here is if you make any transfer of asset to your qualifying group or under business restructuring relief, which are special provisions again under corporate tax, then it is considered to be on the book value itself. There again, a realization event does not occur. So what has been told in transfers between qualifying group is that I want to transfer an asset between my qualifying group, which is a common shareholding of 75% plus. In that case, I don't want to pay the tax today. It's I'm transferring an asset, but I will transfer it at book value. I will not book any gain. They will book the cost at the book value, and there won't be any sale as such, the realization event of the actual profit booking. That will occur when finally the qualifying group member again will dispose of the asset. So even if there is a transfer, per se, if you say from a company A to company B, there is a transfer of asset, there is a sale or a disposal of asset. But if we are going for a qualifying group relief in that, then that will not be a realization event for realization basis payment of tax. And same for business restructuring.
Yeah,
Right?
but I guess from a practical point of view, though, you still have to, if even though from a tax point of view, a transfer is there's no like it's excluded from tax purposes. From a IFRS point of view, from in terms of your financial statements, your standalone financial statements, you would need to obviously book your the gain or loss on an IFRS basis.
So basically, that's the thing that this will all come under your taxable income adjustment calculations, right? So
Yeah,
as far
exactly.
as the precondition of the transfer is that the transfer has to happen at the book value, no profit, no gain basis,
Yeah,
as far as tax is concerned. So you will not claim loss or you will not pay tax on the profit on that transaction. But your books, as you said, it's an adjusting event. So your books will, of course, continue as your books are, but not for tax purposes. Yeah.
yeah. So I think it's important to kind of look at it from a holistic point of view. We're talking about tax, but so we also have to keep in mind the accounting processes and reporting as well, and understand that then comes as an adjustment onto your tax return.
So
That
you and me both do not like to do a lot of sale pitches, but then it is very relevant here to point out that there are certain benefits, there are certain claims, there are certain things now they have come up that okay, if this adjustment was done and if this group is held for 2 years, then you can take the profit. Otherwise, there is a clawback. So if there is a
yeah,
clawback, if a disposal is between 2 years, and then there are, if there was a PI and there are other conditions, other where they have said that you can claim it up till 7 years, and after 7 years, if a transaction is booked, then it does not impact. So all these adjustments track, which are out of books, which are not in your books of accounts, but are your tax adjustments, have to be kept for whatever period are these clawbacks for 7 years, and for your assessment. So for your records, when they say that you have to have your records for 7 years, even these adjustment records have to be kept for 7 years at least, right? And then they
yeah,
might impact the next year and the next year. So this tracking in a proper software, even if it's Taxstar or it's something else, but this software or the tracking of this data is as important as keeping your accounting data and accounting records.
yeah,
People have to see that your first year returns record need to be available for you for 7 years. The basis of calculation, the choices you made, the adjustments you made, the basis of adjustments, if you said it was this value, why, whatever, this has to stay with you for at least 7 years.
yeah.
And
No,
when we
100%.
cover, I think we will try and cover the PI and the benefits of PI, especially when you have local shares or you have outside shares, dividends, capital gain, relaxations. It has a precondition that you should own it for 24 months. You have an intention to own it for 12 months. Now, all those intentional base benefits that you have taken, the records have to be kept for those number of years. So, super important that we start taking it seriously. Yeah. I digress, but this is so super important that I want people to know that you need to take it seriously. Yep. Moving on. Okay. Again, just to highlight, this is the first tax period election. It is irrevocable unless there is exceptional circumstances. It requires FTA approval for revocation. And as we said, based on the type of assets and liabilities and the transactions that you will have in your books of accounts, the implications might be very different for each business sector, or the type, the way you want to do your business, the way you want to utilize your funds if you have additional funds tomorrow, and how that will impact your cash flows on taxation payments, right? So also sometimes you need to take care, if you are part of group companies, if you're part of an international group reporting, it's also important that you align your tax policies and your reporting policies with your group companies across, so you know that these, so you're not creating deferred tax asset liability in one and you do not have such impact somewhere else, and the consolidations and the other discussions get confusing. So different sectors, different ownership style, different plans for the business will impact these choices. So you should not go by, if someone is doing this, it's good for my company as well. Yeah.
Yeah,
So, as we said, these are the document and policies that you will need. You will have to, first of all, be very sure of your accounting policies, how you are recording your assets and liabilities in the books, IFRS compliant, which policy model are you following? Are you going for fair value? Do you want revaluation model? Do you want cost model? Each asset, if you have not done till now, you need that assessment for your opening. because you're opening, only the adjustments and the impacts during the year should be considered, right? For 2024, you can only take the impact of the movement, P&L hit of the value movement between 1st January to 31st December 2024. So your opening has to be correct. So your last year's closing have to be IFRS compliant. If you want to take a fair value, you cannot do a fair value for 2 years together this year.
Yeah.
So these policies and procedures should have been adopted in the last year, and your closings should have been correct. You should have the documents for realization events. Whenever you think the realization event occurred, the supporting documents, why you considering it as realization event or not realization event. And if you choose for realization basis or unrealization basis, the track record unrealized, you have to keep a track if you go for realization basis, that what was it, the adjustment in the books versus when you're finally claiming it. It has to nullify at one point in time.
And we covered the in the last session the elections that you take first time round, and we looked at your opening balance as well, which
Yeah.
is a webinar that's available on LinkedIn and on YouTube as well. So if you missed the last one, highly recommend watching the last one, just to kind of get yourself up to speed with what needs to be done in terms of your opening balances. And obviously, if you have any questions, feel free to reach out offline, to myself or Rashmi, so we can, help you out from that point of view as well.
Sure, makes sense. I think this is more or less what we want to talk on realization basis election, between transition. So now, if we put together what we discussed in last 2 to 3 sessions, we did one on elections, we did one on transition, and we did one on realization. Between
Yeah.
these three, you should, if you now look at your balance sheet, between these three, you should be able to make all your choices. Other than the SBR and others, which are tax losses, is not an election. Will come. I think we'll cover tax losses in our next session.
Yeah.
Other than that, if you see all your assets and liabilities balance sheet part, if it is carried at cost model, you might go back to transition provision benefits if you think that will hit you and you're holding it since long. If it is cost model, you go to your transition benefit first and then see whether you want to carry on with transition or you want to do realization or not. If it is not carried at cost, then transition provision benefit is not available to you. And where do you land? You land on your realization basis. And why? Then if you see that my asset was not at cost anyways, then my profit or loss till the start of the tax period is already adjusted in my balance sheet, right? So therefore, then from there you make the realization or non-realization basis election, and then it impacts only the future profits or gains. It's only where the capital assets get involved that it gets a little tricky to see which will be more beneficial. For current assets and liabilities, if they are at fair value, then further from there, realization and non-realization, therefore the transition benefit is not available to you. So basically, between transition and realization, they have given you almost for all cases, almost for all, the benefit that any profit or loss prior to your tax period will not be taxed once the tax comes into the effect. Yep, that's all about the elections you will make on the P&L balance sheet adjustments. Happy to have any discussion in detail if you need any specific case scenarios. That's it.
No, I think it's quite a meaty subject. It's quite a complicated subject. Conceptually, I think practically it's not too complicated. It's just conceptually a bit complicated because there's a number of steps you've got to think about. You've got to take into consideration your balance sheet, your financial reporting process, and then how does that feed into your tax calculation that you need to take into consideration as well. And obviously, you may have an advisor, you may not have an advisor. How are they understanding? How are they treating it? These webinars are not just for accountants, but accountants may not be the most. You may not have the most technical depth of knowledge in tax, but at least we're giving you the ammunition that you can ask questions to your advisor on how they're doing certain things. Are they doing it the right way? Do they understand what they're doing? And I think this is very important from an educational point of view to ensure that, you are asking the right questions, because, the law is very complicated, and it has a lot of depth. And unless you're, someone like Rashmi, who loves reading corporation tax and, knows it very well and has got a very good background from, previously, then it's not going to be something that's easy to kind of grasp, especially when you have these things that you need to think about from a balance sheet point of view. It's easy to look at the P&L, but balance sheet is also very important from a tax computational point of view as well.
So true. I have never mentioned this, but I think I'll also take one moment to thank Ali Asgar, who's the tax director with JRB, also very vocal and active on LinkedIn, I guess. And this is where my learning of taxation has come. He's 25 years practicing in taxation, so he's the backbone of our tax department. And this is where the thrashing of ideas comes. And the only person I know perhaps who loves reading taxation and laws more than me is him. So I think good for JRB. We do a lot of reading.
Nice.
That helps. Yeah. So I think that's it for today. If we have any questions, we can take it. And next session, we'll take a break for a week, and then we can perhaps go ahead and do tax losses. If at all we have any other suggestion. Otherwise, we'll try and cover tax losses, which is also an interesting 3 articles, 37, 38, 39, but then interesting to cover them in the next session, inshallah.
Inshallah. No, thank you very much for presenting this complicated topic. I know it's not easy to explain because there's a lot of variables that you have to think about. We are now taking Q&A. So if anyone has any questions, please put them into the comment section on LinkedIn, and we can answer them. If you're shy, feel free to reach out to us directly, and we can get in touch in terms of any questions that you have. Any questions so far? We don't have anything at the moment.
I think we can then call it a day.
Yeah, let's give it a few minutes just for people to gather their thoughts. So while we wait for any questions to come, like I said, the next one probably will be first week of March. We'll talk about losses. So now we're going to the P&L side of the computations. Yes. If there are any other topics that you want us to cover, feel free to reach out to us and ask us if there's any specific topics you want us to cover. We are now in Feb, so you almost lost 2 months of your 9 months to prepare your tax and file. You still have time. It's not the end of the world. You still have time, but you do not want to leave anything until August or July. You want to finish everything off from April to June in terms of your tax return. We have covered more complicated topics. So, for some of the larger companies, this is quite relevant for you. And you may not have thought about these considerations just yet. For smaller businesses, doesn't mean you can ignore this, because you need to look at your balance sheet basically and look at what's on there to decide.
While you're saying this, the thought just comes, we should perhaps do one session where we'll try to cover the small business relief, the natural person, the smaller companies' impacts. So the tax losses, of course, impacts everyone, but then there are certain things which will impact the smaller businesses, that is the small business relief and how it can impact you, and the natural person, how and what registration, reporting, etc. requirements are there, which can be part of either. We can cover it with the tax losses. It will only take, I think, 10 to 15 minutes to finish it. So either we do that, and then there is something very important before we move on to the free zones that I think we will tackle in April. Before that, if we want to do, we will have one bit on the PI, participation exemption, and the poem and the understanding of the taxation residency, so that it's again for the multinationals or the bigger groups, but then it's also important. Sometimes we don't realize we have a PI, sometimes we have shareholdings, sometimes we have this. So there are certain interesting benefits, and there is a new decision 302 which has clarified certain things relating to PI which was not there earlier. So super interesting things happening there as well. So maybe we'll try to cover that and then move on to the free zones.
Yeah, no. Free zones is quite a meaty subject, and so yeah, I think that
I'm
would be
still
good as
trying to
well.
struggle how we will try to cover free zone, because free zone, each activity in itself is a discussion point, right? So be it
Yeah,
reinsurance, be it aviation, be it logistics or distribution, whatever. I mean, activity itself is a discussion point in deep depth. So we need to see how much depth we want to go in and how we want to cover it. Once we reach there. But before that, the material concepts, at least other than free zone, if we can cover. So uh, it would have been given the clarification on material parts of your tax impacts on the tax provisions. Yeah.
okay, we've got a question from Tanvia. IAS 41 suggests to realize profit on agriculture that is not sold. How would these industries go on with their corporation tax? That's a difficult question.
Hey, agreed. So it's a very specific industry. I know the livestock and the adjustments for the livestock based on aging. These are all provisional adjustments that you keep need to do based on the agriculture provisions. The same impact. What happens is that you have to see your industry, and then you have to say that whether you want to pay tax on realization or non-realization basis, right? So the same impact comes in any provisioning, any adjustments of valuation based on fair value or based on IFRS that you're doing in your books. If they're not realized and you want to pay them on realization basis, you make that election. And if you think it is too fluctuating for your industry, now you have to see your livestock or your agricultural product type. You have to see how much impact on non-realized basis, and then how much of that actually gets converted into realization. Sometimes there are certain adjustments which are there in books which keep going back and forth, and certain which will get realized. It only parks your tax liability in different periods. So based on where do you think the tax impact will come, how shorter or lengthier your cycles of this are, what is the cutoff materiality at the cutoff stage. Again, it will impact you first year, second year, mostly if you have almost similar value of holding, or say the quantum of holding, then it nullifies the realization gain or loss from year to year. But it's different for different types of assets, and I think if you want a specific solution for a specific type of asset, we can have a discussion. Otherwise, going back, the logic remains the same, that you see how much is the fluctuation, you see how much is the actual adjustments that you will require, and make an election of a realization basis or a non-realization basis payment.
Thank you for sharing that. I mean, look, I think just one thing that came to my mind is, this is a deep dive. So, if you're an owner of an accounting firm, if you're a CFO and you've got an accounting team, we're not charging for these sessions, and these are deep dive sessions, and you could probably pay a lot of money for these types of sessions to other consultants and trading companies. So feel free to share it with your team, with your fellow accountants. We're happy to kind of go through deep dives. We want to answer the questions that a lot of people have, right? The really difficult questions. So these are not like gloss over webinars where we just say, oh, your profit is a certain amount, you just pay 9% and that's it. We go deep into some of the laws and some of the some of the requirements, and it's mainly an education for accountants, so you guys can kind of get the most benefit out of it. So feel free to give us some suggestions on topics that you're stuck on. We could do a deep dive, we can look into it, and we can unpick some of the things that you're finding problematic. If you're finding something problematic, there's chances are that 90% of accountants are finding it problematic as well. They're just not admitting it. so yeah, we're happy to do that. Rashmi, thank you very much for your time. Thank you very much for your expertise. It's been super helpful. We're recording this, so it will be available on LinkedIn. You can see all of our past webinars on LinkedIn. We're sharing it on YouTube as well. And any questions you have, Rashmi can help in terms of technicalities. I can point you in the right direction as well in terms of anything that you need from our side. But yeah, I really enjoyed this session. I love tax. I love the technical aspects of the problem solving, and Rashmi, I know you do too. I know you do as well. So yeah, thank you very much.
Thank you. You all have a good day.
Take care, guys.